If you are new to the market, it can be quite daunting. You hear all these stories about how people become rich overnight, but you aren't sure how they do it. The truth is that trading is hard work and it takes time to become good at it, but the payoff can be tremendous. If you are looking to get started with day trading is the action of buying and selling or exchanging stocks, bonds, or currency within the same day or even multiple times a day. Taking advantage of small price movements can be a profitable game if it is played correctly. Yet, it can be risky for beginners and anyone else who doesn't practice an accurate strategy. Not all traders are fit for day trading. On the other hand, some fit completely with day traders. Now, we'll see 10 day trading strategies for beginners. 1. Knowledge is power. In addition to knowledge, day traders need to keep eyes on the latest stock market news and events that influence stocks. This can consist of the Federal Reserve System's interest rate plans, leading indicator announcements, and also economic, business, and financial news. So, to your task. Make a list of stocks you'd like to trade. Keep yourself updated with the news about the selected companies, their stock price, and general markets. Research on business news and bookmark honest online news articles. 2. Set aside funds. Determine and commit to the amount of capital you're ready to risk on each trade. Usually profitable day traders risk less than 1% to 2% of their accounts per trade. If you have a balance of $100,000 in trading account and are willing to risk 1% of your capital on each trade, your maximum loss per trade is $1,000, 1% x $100,000. 3. Set aside time. Day trading needs your time and focus. In fact, you'll need to leave most of your day. Don't consider it if you have limited time to stand by. Day trading requires a trader to watch the markets closely and spot opportunities that can appear at any time during trading hours. Being attentive and moving instantly are key. 4. Start small. As a beginner, concentrate on a maximum of 1 or 2 stocks during a trading session. Tracking and finding good trades is easier with just a few stocks. Recently, it has become common to trade fractional shares. That lets you define smaller dollar amounts that you want to invest. This means that if Tesla shares are trading at $1,000, many brokers will now let you buy a fractional share for an amount that can be as low as $10, or less than 1% of a full Tesla share. 5. Avoid penny stocks. You're probably looking for offers and low prices, but avoid penny stocks. These stocks are usually illiquid and the chances of hitting the jackpot with them are often generally. Many stocks trading under $5 a share get delisted from leading stock exchanges and are only tradable over the counter, OTC. Unless you see a genuine opportunity and have done your research, stay away from that. 6. Time those trades. Many trades placed by investors and traders start to execute once the market opens in the morning, which results to price volatility. A professional player may be able to notice patterns at the open and time orders to make profits. For beginners, though, it may be better to study the market without taking any trades for the first 15 to 20 minutes. The middle hours are mostly less volatile. Then volatility begins to pick up again near the closing bell. Though the final hours offer opportunities, it's secure for beginners to ignore them at first. 7. Cut losses with limit orders. Choose what type of orders you'll use to open and close trades. Will you use market orders or limit orders? A market order is carried out at the best price available at the time, with no price assured. It's helpful when you just want to enter or exit the market and don't care about getting filled at a particular price. Limit order guarantees price execution at a particular price, but there is no guarantee of the order fill itself. Limit orders can help you trade with more accuracy and confidence because you decide and set the price at which your order should be executed. A limit order can avoid your loss on reversals. However, if the market doesn't touch your price, your order won't be fulfilled and you'll preserve your position. More knowledgeable and experienced day traders may make use of option strategies to hedge their positions as well. 8. Be realistic about profits. A strategy will not always be profitable. The most successful traders may only book profits on 50% to 60% of their trades. However, they book more on their winning trade as compared to losing one. Make sure the capital risk on each trade is finite to a particular percentage of your account and that entry and exit techniques are clearly defined. 9. Stay cool. There are times when the market tests your confidence. As a day trader, you have to learn to keep greed, hope, and fear aside. Decisions should be controlled by logic and not by emotion. 10. Stick to the plan. Successful traders have to act fast, but they don't have to think fast. Why? Because they've prepared a trading strategy in advance, along with a discipline and consistency to stick to it. It is important to follow your strategy closely rather than try to trail profits. Don't let your emotions get the best of you and make you leave your strategy. Remember a mantra of day traders: plan your trade and trade your plan. I hope you enjoyed this video. If you did, a thumbs up would be really appreciated. Here's your reminder to subscribe to our channel and click on the bell icon for more on the trading and strategies. Thank you for watching and stay tuned for more.